Okay, good afternoon, everybody. First and foremost, thank you very much for your time this afternoon. If there's any of you on that were on a few months ago when we did part one of this webinar, you may remember me, but if not, my name is Matt Hodgson. I'm a partner at Claritas Tax, and I lead our Manchester office. We've got three fantastic speakers with us today, but before I introduced the speakers and also the agenda for today, just a housekeeping point, which is you are all on mute, but that does not mean that we don't want your questions and input. So you can submit any questions you've got as you go along via the chat function. They will go to Talia, and after each section, the speakers will answer your questions. So please do submit them as we go along. We've got a fantastic run through today covering three key areas of post-exit cash management, effective wealth structuring, and protecting your wealth. And all of those areas are brought to life by Sam and John through the use of case studies. So some of which are real life, but obviously names have been changed. So without further ado, I'm going to hand over to John Winstanley, Director at Clarion Wealth Planning, to take you through the case study format. Over to you, John.
Thank you. Afternoon, everyone. So what me and Sam thought we'd do today is try and position some of the post-business exit planning considerations in a case study format, just so it brings it to life a bit more, as Matt said. So first and foremost, the case study that we're looking at is very much a typical client that we would come across at Clarion Wealth Planning, but also a typical client that Sam would come across at Claritas Tax. So these clients are Andrew and Angela Smith. Those names are definitely not fabricated. They're mid-40s. They have 3 children in private secondary school. They've just sold the family engineering business for £10 million, and that's obviously what's led them to have conversations with ourselves. They're taking a break from work, or that's the plan, and they may explore a new venture in the future, but it's never going to be driven by wanting to make more money. It would be a passion project, if anything, and they own a main residence currently with a mortgage. Next slide, please. We thought we'd sort of bring to life as well kind of how their asset base sits at present. And for any of our clients at Clarion, they always have their own balance sheet built out. So what we can see from this client is that they've thankfully already engaged with a high caliber financial planner early on in their lives, and they've already put some provisions in place to help structure their wealth more effectively. Next slide, please. And in terms of objectives, this is one of the key points really for any client that we engage with, and post-exit it's even more important because clearly a massive change has occurred in these clients' lives. They've sold a business and they've now got some goals and objectives that they wish to achieve moving forward. So to list those, it's important to them that they can meet their income requirements moving forwards, and they're looking to achieve £200,000 per annum. That's always a key objective for clients when they exit a business. They've gone from the state of being in a position where they're receiving a regular income via salary and dividend, and that needs to be replaced now because suddenly there's no regular income coming into the bank account. They'd like to be debt free. They've got visions of purchasing a mountain holiday home. They'd like to help their children get onto the property ladder in the future, and they want to protect wealth for their children and future generations of the Smith family. Those last two are things that cash flow forecasting, which is something that I spoke about in the pre-exit planning webinar, can really help with, because it can help clients to see how their financial position will evolve in the future, and perhaps whether there is money that's spare and available to give away now or do something smarter with, and it won't impact the client's financial future. And the key with all of these objectives is that during this presentation, we'll help show how they can be met and achieved. Next slide, please. So the first key part of today's presentation is something that I do with all clients first and foremost. For me, it's always the first port of call when it comes to engaging with a client. And we spoke about this again in the pre-exit planning webinar, but the key really is to revisit exactly what the client needs and what they're going to need moving forwards from a cash perspective. So cash management is really, really crucial. We'll always focus on looking at short-term cash requirements for a client. So for this client, we know that they've sold a business for £10 million. That's going to mean that they'll have a tax liability of £1.9 million to pay. So we need to set that money to one side. For all clients that I look after, I'm typically encouraging them to leave 2 years of income to one side in cash. So for this client, that would be £400,000. I'm also encouraging them to think about what one-off expenses they may have. So maybe they'll repay the mortgage in full. Perhaps they've got the holiday home they want to purchase, and that's going to take a slug of cash. Perhaps there are cars to replace because they were previously put through the business. There's usually things they want to do and pay for, particularly when they've received a lump sum. So we need to understand what that looks like. And from that, we can ensure they have enough cash set to one side on day one to meet those immediate cash requirements. And that should enable the mind to be focused on money that could then be used to meet longer term goals and objectives. So we always as well encourage clients to have an emergency fund. That might be 1 year's worth of income. So for this client in particular, we're now looking at them just keeping quite a considerable sum of £600,000 in cash at all times to meet ongoing income requirements in the short term, and also to act as an emergency fund. And the reason we do that is to ensure that the client's income can be met immediately, and that it isn't it's not that money isn't having to come from investments on day one, and therefore the invested wealth can be left to work harder for longer and free from any concerns about short-term investment volatility. So that's something that's really important. If all of that is done well, and you've had an honest conversation with the client about their cash requirements in the short term, it should really help you to understand what they need immediately and what is available to meet those longer term objectives. And again, that's where cash flow forecasting can really assist. Final thing to touch on here is banking. A lot of clients that I engage with struggle with their typical high street banks when they've had a capital event from their business. That might be because they can't transfer the level of money they perhaps want to between bank accounts or to pay for certain expenses, or they suddenly find that they've become their bank's best friend and they're getting a lot of calls inquiring about what they plan to do with the money that's landed in their NatWest bank account. So always something to consider. At Clarion, we work with a number of private banks, and often we find the service is much better, much easier to transact with, and a more, a less intrusive approach when it comes to managing your money. Any questions on this topic at all?
Yeah, there's already been a question that's come through, John. It says, is it wise to hold so much cash when interest rates remain low and inflation is soaring?
Yeah, I mean, I think people have this fear about holding too much cash, particularly when interest rates have been hit historic lows for over a decade, and whilst they're rising now, they're still very low compared to where we perhaps were in 2008. And at the same time, you've got inflation sort of soaring, as the question says. But it's important to have that cash, because what it does, it enables you to forget about the money that you've invested for longer term goals and objectives. So if you know you've got 2 years worth of income parked, you don't need to worry about what your wealth portfolio that's invested is doing. You can be confident that your income needs are met for the first 2 years. It lets that invested wealth work harder for you for longer, and you don't need to worry about short-term investment volatility. Similarly, if you keep 1 year's worth of income as an emergency fund at all times, should we have a period like COVID, for example, where stock markets underperform, and it's not the optimum time to withdraw from your invested portfolio to meet income needs, you aren't forced to do so. You've got something to fall back on, which can help protect your portfolio longer term. So the simple answer is it's not something you should be worried about. What's key is having a diverse portfolio of lots of assets, and if cash is part of that equation, that's your safety net, but the overall portfolio can be working much harder for you, and hopefully, as time progresses, beat inflation longer term. Next slide, please. So I've touched on this subject in the pre-exit planning webinar, but one of the most important things you can do with your financial advisor or financial planner or your tax advisor is structure your wealth effectively. Doing that will help you mitigate tax and enable you to generate tax efficient income with greater ease. It lets you take advantage of various tax allowances that are available to you, and ultimately gives you a much more flexible approach to how you meet your goals moving forwards. And I always term it a multi-pot approach. But essentially, it just involves utilizing all of the various assets that are available to you, all of the various investment wrappers that are available to you, and all of the various tax allowances that are available to you. So if I run through a few of these now, if you engage with a financial planner early enough, perhaps even pre-exit, you've got the ability to start saving into ISAs. You can save up to £20,000 per year, but any growth from those ISA investments will be tax-free. Any income generated from those ISA investments will be tax-free as well. So a very useful tool when it comes to meeting goals and objectives and income requirements following a business exit. The sooner you start with that, the more you can build up in that wrapper as well, because the allowance is lost if you don't use it each year. Pensions, once you've exited your business, there are limited opportunities to fund pensions because it's very much reliant on your earnings will dictate how much you can pay into a pension. So when you exit your business, no earnings, very small pension contributions are possible. But if you've been smart and you've engaged with a planner early on, you've hopefully funded a pension already, and that can form a very useful part of your overall wealth structure moving forwards. You've got the ability to benefit from tax-free growth on that pot of money. You can take income out, which you may decide you want to take out up to the personal allowance, which would be tax-free income once you get past minimum pension age. You could take income up to the basic rate band, so you just pay 20% on some of that income. You've got 25% of your pension fund available to you as tax-free cash, which can help to supplement income needs moving forwards. And something that's really important to a lot of my clients when it comes to a pension is that pension monies will pass to your chosen beneficiaries free from inheritance tax. So a lot of my clients will spend their non-pension wealth first and foremost, leaving their pension till the very end, and that can ultimately pass on to their chosen beneficiaries as a legacy. And that's the way we try to plan things for them. You've got capital gains tax based assets. So these might be unit trusts or collective investments. Essentially, the key there is that, yes, growth is taxed as a chargeable gain, but the rates are more attractive than income tax rates. And each individual has £12,300 per year they can realise as a gain without paying any tax. So if you're smart with that type of investment, you can withdraw money to meet income requirements in a very tax efficient manner. And the final one I'll talk about on this slide is investment bonds. And investment bonds are a very useful tool when it comes to meeting income requirements in the future, and also just investing in a tax efficient fashion. With an investment bond, you can invest either onshore or offshore. And with the latter, no tax is paid until the point you withdraw money from the investment bond, so you benefit from gross roll-up throughout the life of the investment. With both types of bonds, the key here when it comes to income generation is that you can withdraw up to 5% of the initial capital invested each year without paying any tax. And if someone does that 5%, that can last for 20 years. So it's a very useful way of meeting income requirements. Anything withdrawn over and above those cumulative 5% withdrawals is taxed as earned income, but you do benefit from something known as top slicing relief, where in very simple terms, the amount of gain that you are withdrawing is divided by the number of years the investment bond has been held, and that reduces the tax proportionately. So some key investment wrappers there that can be used as part of an effective wealth structure. But this is a really key point just to ensure you've got all your ducks in a row and you've got a number of sources that you can use to meet your goals and objectives moving forwards.
Can we have the next slide, please, Talia? So thanks, John. And as John said, using multi-pot approach can be very, very useful. And what I want to talk about is more the tax elements and how we can structure things more tax effectively going forwards. Now, what you can do when you've got some spare cash is to consider some tax structures. I'm going to talk about FICs, family investment companies, in a little bit more detail shortly. But there's other things like trusts and other alternative investments that we can look at. These could include EIS investments, VCT investment. And again, I'll go into those in a little bit more detail. Of course, you do need to think about your overall risk profile, which is something that you can do with John. But it is worth bearing in mind that there are these other structures and sources that you can put your money into that could have tax advantage. Of course, if you've got spare cash, the best thing to do, of course, for inheritance tax planning is either spend it or to give it all away. So if you've got cash or cash equivalents, which could include investment bonds that John was talking about, you can give those away during your lifetime to another individual free of IHT provided you survive 7 years. If you do die within 7 years, potentially there could be a charge come in, but depends on the value of the gift. If we're not talking about cash, you do need to be careful. There's a little saying in tax that if IHT doesn't get you, CGT will. So if you're giving away assets during your lifetime, you need to make sure you're not accidentally triggering a CGT liability. Other areas that John had on his slide above were to do with property. And as we've said, Mr. and Mrs. Smith are thinking about buying a holiday home. Now, as I'll talk about fix in a minute, you can hold property within a family investment company. Often we don't advise that for holiday homes, because holiday homes are generally there for your own enjoyment and for your own use. If you start using a holiday home that's held within a company, then we've got benefits in kind and all kinds of other issues. We could have ATED, we could have lots of other administrative things that we don't want to do with. So we need to think carefully about the structure before we do it. One thing that's going to have a bearing on that is the legal requirements in other countries. In some countries, they don't recognise things like trusts as a form of ownership. So in some countries, things are held in different structures just because that's what's recognised in that country. Some countries still have forced heirship rules. And by that, I mean, you're not at complete liberty to do with your assets as you will, because you are required under the rules in those countries to leave assets in a certain way. Now, while we were in the EU, to extent we were protected from that, but now we're not in the EU. France in particular has come out and issued a new directive that says anybody who's got, you know, French property or French interests is going to be subject to the French heirship rules if they're outside of the EU. So that's just something to consider. IHT, if you're UK domiciled, is levied on a worldwide basis, so it will include your overseas assets wherever they are. That's not to say there won't also be potentially tax liabilities in that country if the property is situated there. So we need to take that into account. And it's always a good idea, if you have foreign property, to have a specific foreign will to deal with that property, as I said, to avoid tripping up over some of those forced heirship rules, the legal requirements and the tax problems in those other countries. If you could change the slide, please, Talia. Again, looking at property, which could be your home, thinking of mortgage property, although we've said that we want to pay the mortgage off. If you consider your ownership structure, that's, we may have heard the concept of joint tenants or tenants in common. In simple terms, if a property is owned as a joint tenant, on death, the other joint tenant will automatically inherit the other half. Whereas if it's tenants in common, you can leave your half of the house to whomever you wish. Now, that can be very useful in tax planning if we want to leave half of the house not to the joint owner. But again, that needs to be looked at as part of an overall thing. More recently, I say Mr. and Mrs. Smith have said they want to be debt free, so they want to pay off their mortgage. But in recent years, we've found people actually deciding not to do that or even take out larger mortgages, which sounds a bit counterintuitive. But mortgage rates have been so low recently. Some people have been taking the decision that if I've got, you know, £200,000, rather than paying off my mortgage, I'd rather invest that with John and generate a return that's actually going to be a greater rate of return, even after any tax, than I'm paying on my mortgage. So that's something to consider. Just that bottom point there about SDLT on gifts. SDLT is stamp duty land tax. If you gift something, there's no SDLT liability because SDLT is levied on the consideration. However, if you want to start gifting properties that do have mortgages on them, then there will be an SDLT charge. It's just a little trick that trips people up sometimes. And the last thing to think about in terms of income is to do with the school fees. They have children in secondary school, presumably paying quite high levels of fees, which is going to require high levels of income to service those fees. Now, in Mr. and Mrs. Smith's case, there's not an awful lot we can do in terms of school fee planning, although they could do school fee planning for future generations, for grandchildren. If you can set up a grandchildren's trust, that can be a very tax efficient way of utilising the children's own allowances in order to generate income for them, out of which the school fees are paid. Just because they can't do school fee planning, though, they could do university fee planning. Once the children are 18, the trust planning can work. And again, the children, the student at university then generates an income from the trust, pays either 0% tax if it's in a personal allowance, or lower rates of tax to the extent it exceeds it. And they can then use that income to support themselves through university, rather than the parent having to fund that out of taxed income. Can we have the next slide, please? So I mentioned family investment companies earlier. You may have heard about these, you may not have done. They have been around for a little while now. A couple of years ago, the Revenue set up a specialist unit to investigate the use of family investment companies, quite simply because they were concerned that this might be some means of scurrilous tax avoidance that they were missing the trick on. They disbanded that, I think, probably 12 months ago now, because quite simply they said that these were used by people who were wealthy enough to have an inheritance tax liability, but not sufficiently wealthy that they have, family office type arrangements, and that broadly they're used for family succession purposes, which is the context in which we're looking at them here. Mr. and Mrs. Smith are post-sale, so they've got a load of cash. Family investment companies can be structured in a number of ways. The most common way in which we structure it is by means of a loan. That's so you've got your cash from your business sale, you've paid your capital gains tax on it, so the remainder of the cash you've got left is tax paid cash. And that means that we can lend it into the family investment company, and then we can potentially draw back down on that loan if we want to. Within the family investment company, we can invest in anything we like, really. Anything that a company can hold, the family investment company can hold. So quite often we'll see family investment companies investing in stocks and shares portfolios, and you can do that through John. But you can also invest in property, as in rental property portfolios, or other investments if that's what would be your preferred. As I said, not necessarily recommended for holiday homes, and certainly not recommended for trading activities, because the point of a family investment company is for investments. If we've got a trading company, there's other things we can do in terms of IHT planning. Note that if the family investment company itself is investing in trading companies, it needs to hold at least 50% of those for it to be counted as trading activities. If it's investing 25% in a hairdressing business, for example, then as far as a family investment company is concerned, that's still an investment, regardless of the fact that that's a trading company. And the reason that we're doing this is that the FIC itself forms a low tax or even a tax-free wrapper for growth. John was talking earlier about offshore bonds, allowing you to get gross roll-up. You can do a similar thing within a family investment company. Dividends received by companies are received free of any tax. They don't pay corporation tax on dividends. So essentially, the company can receive this income and retain 100% of that income for reinvestment. If we're talking about rental properties, then the company is going to be paying tax on any rents received at currently 19%, possibly going up to 25%, possibly not. We'll have to wait and see. But either way, it's still lower than the likely marginal rates for individuals of 40 or possibly even 45%. So what is the IHT element of a family investment company? Well, in simple terms, if you loan the money into the family investment company, the capital on day one, the value of that company is going to be nil. If you loan £1 million into a family investment company and invests that £1 million in stocks and shares, the overall value of the company is nil. But over time, you would expect the value of the investments to grow and the value of the loan to either stay the same or be reduced. And what you can do is structure the shareholdings of the family investment company such that the growth passes outside of your estate. And it could be that you don't want any more than the loan that you've put in and all of the growth can pass outside of your estate, or you may want to share the growth with your estate. That's entirely up to you. It's just we need to structure the shareholdings carefully to make sure that that's achievable. You can use them in conjunction with trusts, as in the shares in the FIC could be held by a trust. And then that's an additional layer of protection in case of, family breakdown or anything else like that. As far as generating a tax-free income is concerned, quite simply, if you've loaned money into a family investment company, provided the money is there to enable repayment, you can seek repayment of that loan however you like. I mean, you could use it in a similar way to an insurance bond where you draw 5% a year for 20 years. Obviously, at the end of that period, you've drawn back all of your loan. And then, the rest of the growth will remain outside of your estate if that's how you've structured it. You don't have to draw it at 5% every year for 20 years. You could draw 10% in year 1, 20% in year 2, and then nothing for 5 years. It's entirely up to you. It's very flexible. And as I say, it's not actually income, but in terms of, when we're looking at our overall income requirements and how much income we need to generate, which John will talk about in a second, it's just another source from which we can receive money into our bank account that we can spend without having to account for a tax deduction from that. If you could have the next slide, please. Sorry, has anybody got any questions before I move on?
I was just going to say, there has been one that's come up that says, can my FIC invest in a new business I set up?
Going back to the point I was making about trading businesses, it's not normally advisable because if you have a trading business, then there are alternative IHT reliefs we can get. As I said, a family investment company is to make investments. So if it was just a small cash injection, possibly, but again, it's still only going to be an investment in terms of the FIC. The alternative is you could set up a different kind of company and make loans from that company into your new businesses, which again can be helpful for IHT planning, but it's just a slightly different structure. Okay, so if there's no more questions, as I say, John mentioned VCT and EIS on his slide, and I'll talk a little bit more about business relief, which I've just touched on there with FICs. So venture capital trusts and enterprise investment schemes are basically tax advantaged investment schemes. And quite simply, these are riskier investments. So in order to compensate for the risk, thinking about risk reward, the government offers incentives to get people to invest in them. The two schemes are slightly different. Venture capital trusts is more akin to like a unit trust where you're spreading your risk across a number of different companies. The amount you can invest in is lower, but all the dividends you receive from venture capital trusts will be tax-free, which is useful. Enterprise investment schemes, and there's also a smaller scheme called seed enterprise investment schemes, can actually offer you significant tax advantages over the whole thing. You can get up to 30% tax relief on your investment. Now, for EIS, you're capped at a maximum of £1 million per tax year, or £2 million if it's in a knowledge-intensive company. For SEIS, the limits are lower, but you get 50% tax relief on SEIS. So if you think about it, if you're making an investment, you're actually only risking half of your money up front. For both EIS and SEIS investments, any gain on the company itself is exempt from CGT, but there's also an additional advantage which allows you to defer your capital gains tax liability. Now, to get full income tax relief on EIS and SEIS, you need to not have more than 30% interest in the company. But actually, if you want to get the capital gains tax relief, that criterion doesn't apply. So if we go back to Mr. and Mrs. Smith, John was talking about them having a £1.9 million capital gains tax liability. But actually, if they wanted to invest some money in an EIS scheme, they could defer that gain and only pay the tax on that once the enterprise investment scheme investment was realised. And basically what that means is you're using the money, that £1.9 million that you had or that you would have paid over to the taxman, and you can instead put that in this enterprise investment scheme and potentially end up you know, much happier at the other side. Of course, you do have to bear in mind that these are risky investments. Some of them go into Stella, many of them don't. But it is basically by doing the CGT deferral, you're making that riskier investment with essentially somebody else's money. Of course, if it does go pear-shaped and you lose your investment, you've had some benefit up front in your income tax relief. But the deferred gain will eventually come into charge, even if the investment goes bad. The difference with that, with the SEIS scheme, is that also 50% of the amount invested can actually be written off a capital gain. So it's not deferred, it's actually completely removed, which again can be very useful. But of course, the SEIS are even smaller companies, so are even riskier. So, you know, risk reward, you need to decide whether that's for you in terms of the overall investment strategy. The last thing is business relief qualifying investments. Now, business property relief, as we normally call it, allows for up to 100% exemption from IHT. You most commonly see it in terms of trading businesses. So if you've got a family business that's making widgets, the point of the relief is such that, you know, when the head of the family dies, they don't have to break up the business or sell the business in order to meet the inheritance tax liability. So if you've got that kind of business, then that's fine. As I always say, you know, you sell your business, you give yourself an IHT liability. But what you can do is invest in business relief qualifying investments. So enterprise investment scheme and VCT shares might qualify for this, because you need to invest in sorry, I'm getting feedback, I'm not sure if anybody else is. You need to invest in small unquoted company shares. They don't have to be small, they have to be unquoted. So the EIS will qualify, but also you can invest in what's called an AIM portfolio. So your broker, and as I say, John could do this, could pick a selection of qualifying companies. And again, you can spread your risk by investing it over a portfolio, but provided you've held that for the minimum period of time, you'll get 100% IHT relief on that. The other thing that's available at the moment is you can invest in one EIS company, but they can be very big companies. They're essentially portfolio companies. So although you are still putting all your money in one company, the risk is spread across various different income streams, and it just reduces the risk slightly. Again, these things tend to be fairly illiquid, so it's not something you want to invest in and out of very quickly, but as part of an overall strategy for both income and, you know, looking forward to IHT efficiency, they're really something that you should consider. I'll move on to the next slide unless there's any questions. So before John talks about trying to generate tax-free income, I thought I'd just outline, you know, the income tax position as we have it at the moment. Broadly, income is taxed at 20%, 40% and 45%. Obviously, the 45% rate kicks in with income over 150,000, and 40% is just over 50,000 when you add on the personal allowance. Currently, we have the additional 1.25% health and social care levy. That's added on to national insurance. It's also added on to employers' national insurance, but possibly that might soon be scrapped. Certainly that's something that Liz Truss has been talking about. And that would obviously hit people's pockets when people are struggling, but also employers' pockets where, you know, if they were cutting the employers' national insurance, that would obviously be a saving to those businesses as well. Dividends are currently taxed at 8.75, 33.75 and 39.35% because those rates also have the 1.25 rate added on. Liz Truss has been less forthcoming about whether the dividend tax rate will also be reduced because, you know, from a legislative point of view, the increase in national insurance is one piece of legislation, the increase of tax rates on dividend is a different one, so she could withdraw one but not the other. Personal allowance for income is 12,570, and that has been frozen for the next 6 years, but again, that may be something that comes under review with the new government, particularly as inflation rises and people are seeing, you know, their real spending income drop dramatically. Of course, that personal allowance is withdrawn if you have income over £100,000, which gives you this weird blip where between 100 and broadly £125,000, the effective tax rate is actually 60%. We've also got capital gains tax, and capital gains are taxed at 20% or 40% unless it's residential property or carried interest, where those rates are 28% and 40%. There's no additional levy for health and social care on capital gains tax, and you also get an additional £12,300 capital gains tax allowance. So if you are in the position to be able to generate both income and capital gains, which you could do if you had an investment portfolio, that can be a way of essentially getting more income, if you like, more money in your bank account to spend, but taking advantage of the most tax efficient way of doing so. So capital generation is generally advantageous, but you do need to consider the whole picture. As John said earlier, pension funds can pass to descendants, beneficiaries, free of IHT. So quite often, if you're looking at generating income and what potential sources there are, you might think about trying to generate income from other sources and leaving the pension where it is. Again, in terms of trying to maximize allowances and lower rates, we only need to generate income when it's required. There's no point, go back to the pension example, if we had an annuity that's generating £50,000 a year, but actually in 2 years we've got large gains and we don't need that income. If we can have more flexibility over when we can generate income, that gives us more flexibility in paying the least amount of tax possible. And that's it really. I spoke earlier about the school fee planning and how clearly if we're paying 45% tax, the amount of income needed to pay a £10,000 school fee is going to be significantly larger than £10,000. But I think John is going to cover now about how you could possibly generate some income without paying any tax at all.
Thanks, Sam. That was a sort of a good intro into this slide and just a sort of a high-level overview of the various tax rates that are payable. So this is where the magic happens for clients, because this is all they're ever interested in once they've sold a business and they haven't got that regular income coming in anymore. So for Mr. and Mrs. Smith, they're wanting to generate an income of £200,000 per year to meet their needs moving forwards. And we've spoken previously about this being done via a multi-pot approach. And this is why structuring your investments as early as possible is crucial, really, because it will enable you to do this in the most tax efficient way. So if I talk through this slide, the clients need to achieve £200,000 and they'd like to pay as little tax as possible. So how are we going to do that? Well, they've got their SIPs that we evidenced in an earlier slide, but we're going to take no income from that because 1, they're not yet 57, so they can't access their pension funds. But 2, I've evidenced via a robust process of lifelong cash flow forecasting that they don't actually need to touch their pensions. That money could sit there long term and be deferred for IHT purposes. That money can pass on to their chosen beneficiaries free from inheritance tax. So there's going to be no income coming from the pensions at this juncture. They've got ISAs, which they've saved in already, a portfolio value there of £168,000. No tax on those ISAs at all. So they can take a natural income from those ISAs, and that would be around £6,700. The general investment account or collectives can provide income in 2 ways. Investment portfolios typically have a yield, which may be derived from fixed interest investments or dividends from shares. For this particular portfolio of £400,000 that the Smiths have, it's kicking out a yield of around 1%. So £4,000 in income from that portfolio, but there'd be no tax paid on that because that falls within their combined annual dividend allowances of £2,000 each. We can then generate a further £17,300 from that portfolio by selling investments on an annual basis and realising gains within the annual CGT exemption. So for a married couple, as Sam said already, £12,300 of gain can be realised each year without paying tax. For a couple, it's £24,600. So we could sell part of the portfolio, realise a gain up to that amount, and quite comfortably remove £17,300 as a capital withdrawal to use towards income. That £17,300 is a slightly strange figure, but it was essentially me filling in the gaps once I've generated the other income. So it's not set in stone, but it would be achievable. The investment bond, these clients have decided that, having reviewed all of their finances and what they may need moving forwards, they've probably got a further £4 million that they could invest in one way or another to meet their income needs. £2 million of that is going to be paid into an investment bond, and they can withdraw up to 5% per annum from that per year tax-free. So that's going to give them £80,000 in this example. And the family investment company, which Sam's spoken about, they've loaned £2 million to that family investment company, and they can withdraw down on that loan at their leisure, and that will be a return of capital, and again tax-free. So that's £80,000 from the family investment company as well. And finally, something Sam touched on one of the last slides, venture capital trusts. And yes, they are higher risk investments, but they can form a very useful part of an overall portfolio, particularly for assets that are earmarked for the upper end of the risk spectrum. One, it can help to boost potential returns from the portfolio, and in the current climate, when people are chasing inflation beating returns, that can be very useful. But one of the best things about the VCT or venture capital trust is the ability to generate tax-free dividend income. So for a £400,000 portfolio, dividend income of say 3% per year is highly achievable. That would be tax-free, and that's a further £12,000. So for Mr. and Mrs. Smith, because they've planned diligently, because they've put multiple structures in place to meet their income needs moving forwards, we're able to generate income for them of £200,000 per year, and they're not having to pay any tax to achieve that. So it's placing less stress on their overall portfolio, and hopefully enabling their hard-earned wealth to work hard for them longer term. Any questions on this for me at all?
Yes, we've got a couple of questions actually, John. What happens if my circumstances change and I need more cash now? The first one.
Well, if you recall from the beginning of the presentation, I'd said that we set money aside for our clients. We park money so that it can be accessed if they have an emergency, if they need more money in the short term. But also, as Sam's alluded to, some of these investment wrappers are highly flexible. If more money was required, more could be drawn on the loan that was paid into the family investment company, and there's no limit on what can be withdrawn there. So you can be very flexible with this, but planning is crucial.
Did you want to add to that, Sam? Sorry.
No, I was just
Other questions, Talia?
No, that's fine. Another one's actually come through the portal. It said, sorry, John, did the private pension retirement age, did you say it was 57 because this person thought it was 50?
It could be 50 if you've got a very specific type of pension contract that says you can have your pension at age 50, but the norm is currently age 55. In the next couple of years, it's increasing to age 57. And sadly, for individuals as young as me and Sam, it's probably going to be 58, unfortunately, and possibly increasing further. So 50s would be very unusual unless it specifically says it in your pension contract. 55 is the current norm, but it's due to increase to 57 in 2024.
And just one more, sorry. Is it possible to meet income needs without paying any tax?
In this particular example, yes, it is. It may well be that in 20 years' time, the client does have to start paying some tax because those 5% withdrawals from the investment bond have been exhausted. But for the very long term, it's possible to achieve this level of income highly tax efficiently. And as I've said, it reduces the stress on your overall wealth moving forwards, and therefore should make it last much longer.
Okay, so we've talked a bit about income. We just wanted to cover over some of the more IHT focused things, and just worth going over what the tax planning landscape is in terms of IHT. I mean, IHT is one of the least popular taxes, and nobody wants to pay it. Although IHT actually only contributes a very small amount of the UK tax take, it's less than 2%. Although as values are going up, that tax take is creeping up. I mean, broadly, you'll pay 40% tax on any assets owned over the nil rate band, which I'll talk about the residence nil rate band in a second. But the nil rate band itself has actually been frozen at 325,000 per person since 2009. So, you know, forget about the income tax allowances being frozen for 6 years. That's been frozen, you know, for a good 13, 14 years. I mean, if it kept pace with rises in house prices, just as a basic, the nil rate band should be over £520,000, and in London that it would be more than double. But you know, that's IHT isn't a politically friendly tax, because you know, people think that people should be paying IHT if they've got significant wealth. The residence nil rate band was introduced a few years ago, and the idea of that was to add up to an additional 175,000, such that each person would have a maximum of 500,000, which between the two of them would give you £1 million. And the point of this was to try and say that, you know, if you've got a house worth up to £1 million, you're not going to pay any inheritance tax. The flip side of that, of course, is the residence nil rate band is actually means tested almost. If your total estate is over £2 million, then you won't get the full amount of residence nil rate band. It goes down on a sliding scale. So broadly, by the time your estate's worth, you know, 2,350,000, you won't have any nil rate band left. So for Mr. and Mrs. Smith, you know, they're probably going to end up with significantly more value than that, not including the value of their pensions, of course. So they may not actually get that residence nil rate band, but it is an important point to be aware of, because, and particularly if you or your clients have estates around that figure, there are certain steps you can take to try and get that number down under the £2 million in order to benefit from the full residence nil rate band. It's also worth bearing in mind that while you get 100% exemption for business property under business property relief, that doesn't apply when we're looking at the nil rate band. If you have a business worth £2 million, your estate is worth at least £2 million. IHT has been described as a voluntary tax. You know, provided you spend everything that you need to 7 years before you die, you won't pay any tax. But of course, it is impossible to know exactly when you'll die and exactly how much you're going to spend. However, John has got his tools and his, you know, planning software that he can use. So as you say, you can work out, as Mr. and Mrs. Smith did, how much of their wealth is excess. And then we can look at doing some planning with that to get that out of your estate more than 7 years before you die. Are changes off the table? Well, the previous, well, how many chancellors ago was he now with all the late changes? But Rishi Sunak did look into making some changes to IHT, but in November 2021, he wrote a letter to the Treasury in which he said that there were no further plans to reform IHT in the, you know, the forthcoming future. Of course, that was in a whole nother epoch of Conservative government, so we don't know what's going to happen now. Again, the IHT take is so small, it's not going to help redress the economy. And of course, the big issues at the moment are about changing the amount of money in people's pockets rather than, you know, inheritances. So I can't think that IHT would be top of the agendas, but you know, you never know with tax. Can we have the next slide, please? So looking at IHT planning in the context of Mr. and Mrs. Smith. So as I said, they've sold their business for £10 million, essentially giving themselves broadly a £4 million inheritance tax problem. But they are only in their 40s, which is relatively early for IHT planning based on, you know, people's longevity these days. And of course, in your 40s, you've hopefully got quite a few years left in you in which you want to spend some of your you know, hard-earned gains. So, you know, it is important to involve somebody like John in terms of planning for the future and how much that you'll need. But it is also worth bearing in mind that if you have an IHT problem today, when you're in your 40s, by the time you're in your 80s, that IHT problem is generally only going to be worse. So the earlier we can start planning, the better, and it gives us more scope and opportunities, particularly as IHT works on a 7-year rolling basis. If you start in your 40s, you've got quite a few lots of 7 years in which you can do planning. That could be with trusts, which I'll talk about in a second, or it could just be in terms of, you know, giving assets away and ensuring that you survive that 7 years. In terms of business sales, I mean, obviously you will all have been at the previous webinar where we talked about pre-sale planning. And what that means is that there are some options available for IHT planning purposes in the short term before a sale. Often this involves business property relief where we've got shares in an unquoted company. But there's a limited window of opportunity to do that. Now, in Mr. and Mrs. Smith's case, they've just sold out completely and they've got all of the cash. So some of those options are no longer available to them. But it may be that other people, when they sell it, they may do, you know, a partial sale now. Maybe there's a private equity buyer coming in. Maybe there's, you know, a partial management buyout. There may be scope for future events of realizing some cash from shares. So there may still be the opportunity to do some of this planning on a second liquidity event. So don't write it off if the first sale has already taken place. And then, of course, we've got to do some post-sale planning with the spare cash. What's spare? Well, you know, you've talked to John, you've done all your modelling, and so you know what's spare. You've worked out what you've put everywhere in terms of generating that income as John modelled in the most tax efficient way. So you've put all of those things in all of those pots, and, you know, do you have anything left? And that's really where we are. If we've got anything left, what can we do in terms of IHT planning? Can we have the next slide, please, Talia? So one thing we can do is use trusts. Most people are familiar with the concept of trusts, and as I said, there are opportunities to settle larger sums before a business sale, but afterwards we're limited to putting 325,000 in every 7 years. And the reason it's limited is because the IHT benefits of trusts can be really quite valuable. Basically, once you've put assets into trust and you've survived the 7 years, then that amount of assets in the trust will never ever pay IHT at 40% for the lifetime of the trust. And this means that it can grow and it can roll up, and it's not going to have that massive hit of 40% every time somebody dies. Now, trusts do have their own IHT regime where they pay a maximum rate of 6% every 10 years. The exact rate varies. In simple terms, the closer the amount in the trust is to 325,000, the nearer that rate will be to nil. But paying a maximum of 6% every 10 years has cash flow advantages and also roll-up advantages against paying 40% every time somebody dies. So they really are quite efficient, and that's why you'll see so many wealthy families with trusts. It can provide income tax advantages for grandchildren when we're talking about school fee planning earlier. If we generate income for the children themselves and use their own income tax allowances, that can be very efficient. There are various ways of structuring trust, but often we can do it and we can invest it. We can talk to John about investing the assets within the trust such that we're only generating the amount of income that we need to pay out to people to try and minimise any additional tax being paid. And as of course, as I said, IHT runs every 7 years or 7-year cycles. So if you can put 325,000 in now, and if there's a couple, that's 650,000, and you do it now when you're 40, and you do it again when you're 47 and 54 and 61 and 68, you can see that over time, you can actually get significant amounts of value outside of your estate. And not only are you putting these assets into trust where they're not paying the 40% tax, you're also effectively replicating your 325,000 nil rate band. Because if you've settled a trust and 7 years later, 7 years and a day later, you die, your 325,000 band is refreshed, and the trust also has a 325,000 band to itself. So the more trusts you create to use that 325,000 band, the more exemptions from IHT you're getting. So over time, that can be very valuable. And the last thing that Mr. and Mrs. Smith talks about was about helping the children getting on the property ladder. Now, they could make outright gifts to them, just give them some cash. As I've said, if they've got cash, they're not generating any CGT by realising that cash, they can gift the cash, and provided they survive 7 years, that's outside of their estate. Alternatively, you can make loans. And then, of course, if anything goes wrong, you can call it back. But again, you could also make gifts or loans out of a trust. And quite often we see people making loans out of a trust, or even buying properties within a trust, because if anything goes wrong in terms of divorce, then there's always that scope to pull it back. But finally, it is worth mentioning that trusts will pay the SDLT surcharge if they buy residential property. But if not, you can use if the child is a life tenant, they can use their entitlement to the first property, but then that means they won't have it in future. So that's just worth bearing in mind, particularly if we're looking at more valuable properties. Sorry, next slide, please.
Just to close, really, I mean, we've spoken about protecting your wealth in terms of trusts and inheritance tax planning. Final things to think about from a sort of an overall financial point of view. Very important to have an up-to-date and robust will in place post a business exit, because your circumstances have changed considerably, and that can help to ensure that in the Smiths case, money is protected for children and future generations of their family. Equally, powers of attorney are important to ensure that your finances can be dealt with as required if something were to happen to you. And the final thing on there, which is demonstrated by this picture of the family, is I think it's very important when you have these kind of events to start educating the next generation very early on. So start to talk to them more about money, bring them into the meetings that I have with my clients, get them to understand how the family finances work and what's going on in the background. And something that can assist with that as well is what we refer to as a family charter. And that can help to put some guidelines in place as to how family wealth should be used in the future. It might dictate how education should be funded further down the line, or indeed, dealing with more sensitive subjects like cohabitation agreements and prenuptial agreements to try and protect family wealth, but doing it in the frame that that's the way our family does it, and that can be a very useful exercise. That's everything from us. Are there any other questions from today's webinar?
We've just got a couple, conscious of time. Can I be a settler, beneficiary, or a trustee? And can I borrow money from the trust? I think that's for you, John.
I think it's probably for me, actually.
Oh, sorry. Yes, sorry, Sam.
Bring that for Sam. Definitely for Sam.
The settlor is the person who's put the money into the trust. You can be the settlor and the trustee, as in you can put the money into the trust and then also be trustee and control the money or the assets in the trust. You can't also be a beneficiary. The person who put the money in cannot benefit from the trust, because then it becomes a settlor interested trust, and basically you lose a lot of tax advantages. It is also possible to be a trustee and a beneficiary. So the people benefiting from trust can essentially control their own assets. Often that doesn't happen until a bit further down the line when people are a bit older. In terms of borrowing money from the trust, presuming this question is coming from somebody who's put the money into the trust, I'm going to say ordinarily no, that there are certain circumstances in which you could do it, but it's not generally advisable. Again, back to the point of being settled or interested, you'd need to pay a commercial rate of interest. And there are also some other anti-avoidance provisions that it's generally not worth doing if if you can possibly not avoid it.
Sally, I'm just conscious that we're out of time now, so I just want to thank the speakers for very insightful look into what people can do post-transaction with wealth, and how it can be invested cash tax efficiently to create an income stream going forward. Any further questions can be submitted. Talia's going to circulate the slides to all the attendees, and if you've got any further questions, please send them through. But once again, thanks for your time, and enjoy the rest of your day. Thank you.
Bye.